Hey, welcome back, everybody. The Presidio Perspective. We got a great show for you today. The DodgeFather on Saturday Night Live. We'll talk about that. Should we listen to the Fed? Biden wants to eliminate 1031 exchange with massive implications for real estate investors. Talk about inflation, more and more of it, and how do we best time the market. So I think we're ready. Luke's got his headset on. Sierra, need you on the ones and twos. Let's go. All right, and we're back. I'm Dustin TenBroeck.
Yeah, and I'm Luke Jacobson. Welcome back to the Presidio Perspective.
All right, so Elon Musk on Saturday Night Live, the DodgeFather himself. Did you catch the episode?
I did. In fact, I caught it because my 11-year-old daughter made me watch the replay
No
on
kidding.
Monday.
Wow.
She was interested and wanted to see all Elon had to bring. I thought that was really interesting.
Yeah,
Right?
that is interesting.
Right? I mean,
Go Gemma.
right?
Yeah.
Go Gemma. Wanted to see it and wanted to see it all, and actually didn't want to see Miley Cyrus. Skipped right past it and just it was all Elon
She
all
was
the
pretty
time.
Good. She was
Yeah,
pretty
right?
good. She had a good cold open for Mother's Day, and yeah, I thought she did an okay job.
Right?
So what were your thoughts? Any takeaways?
You know, my takeaway is that I thought it was just stunningly brilliant for Elon to step into the limelight and try to be like connect with people.
Cool, normal guy.
Yeah, but I thought it was really intelligent for him to legitimately see that in order for him to accomplish the goals that he wants to, he needs buy-in and support from a lot of individuals.
Yep.
And saying, okay, I'm gonna go dress in 5 or 10 different costumes that look nothing like everything I've ever done and really gain support and connect with a lot of people.
Yeah.
It worked for me.
Yeah.
I thought it was really cool.
I thought so too, but I think we're in the minority if you read the headlines. He has a lot of critics coming out and, what is the CEO doing, spending a week of his year, producing sketch comedy, right? When he has, multiple full-time jobs, probably one of the hardest working people on the planet.
Probably.
But, there's been some fallout in some of the things that he said, on the show and then following with some tweets later on, right, that have affected cryptocurrency. So I don't know if you caught the weekend update section. That was my favorite part. He was on there with Colin Yost and Michael Shea, which they have great rapport.
Yeah.
Not Luke and Dustin rapport, but great
not
rapport.
That. Yeah, okay.
And so, they're questioning Elon to try to explain cryptocurrency and digital currency with the specific one that he's out there promoting on Twitter. And, they're going back and forth. He's talking about, how it's blockchain revolutionizing the future. And they said, so it's a hustle. He said, it's a hustle.
Yeah, it's a hustle. I did see that.
And so that, particular coin fell off 30%, since then, or $24 billion. I think his publicly traded company's down about 11 or, another 15, $16 billion. So $40 billion lost since the SNL episode. So one of the most expensive episodes probably that Saturday Night Live's ever hosted, one could argue. But he had some tweets afterwards on his company not accepting the cryptocurrency that they were accepting for payment, right? Citing kind of implications for the planet, climate, and use of energy and fossil fuels.
Yeah, and I don't know, my first take on it, before you and I had our previous conversation was, well, that's very interesting to me, the pot calling the kettle black. Here's a gentleman who's going to use electricity to basically drive all our vehicles everywhere, but please don't use electricity for cryptocurrency. Oh, by the way, I'm using electricity to send you this tweet right now.
Yeah.
And but after our conversation, and maybe you want to explain it, that just the slope of energy usage for electric vehicles and where that takes the planet versus potentially cryptocurrency. It could have there could be something there to talk about.
Yeah, I mean, mining specific cryptocurrencies is really taxing on energy resources and it's kind of exponential. You need, when you have finite supply, you need more and more energy to do the mining. And so I think, somebody like Elon, who has a very long view, right, planning our civilization in Mars, you got to have a pretty long view to try to start working towards those goals. I think just kind of look at trend lines of what he's trying to do with energy efficiency over time with his other companies and how it didn't resonate. And a lot of the critics are saying, well, wasn't that all true 6 months ago, right? Or a year ago when you were making the decision? But I think that's something that you and I have talked about a lot, is what business leaders, effective business leaders, need to do. Look, The reality is the smartest people on the planet and the most effective business leaders on the planet get it wrong. I mean, and so that's just how the world is. And if you're going to be really effective, being able to have that decisive ability to admit when you are wrong and change course, I think is really what separates the pack as far as the elite versus the good. And so, critics can say, well, wasn't that true? And he said, yeah, I missed it, and I mean, I think that's just evidence of good leadership there, making those decisions. So anyway, we will see. Anyway, it was fun to see him on there. And so, yeah.
It was fun to talk about cryptocurrency. We don't talk about a lot. We don't advise on that type of a product, but I do have these casual conversations. People want to ask about it. One happened yesterday. And I think my simple answer is, for people who are kind of asking the questions, what is this and what's going on, without providing advice on what you should do, is that blockchain is real. It's going to have a huge impact on your life. There's lots of different use cases and different variables of blockchain. And my recommendation is to stop putting a wall up to blockchain, let some of that in, try to digest what is going on and how it might impact your life, and start learning about it.
Yeah,
that's my call.
Yeah, which is easier said than done. It's pretty
very
heady.
True.
Yeah. All right. Well, let's move on to our next subject. You said it's time to listen to the Fed with a question mark there. So what do you mean by that?
Well, so the Fed is still saying inflation's transitory, right? So we have these huge step function. We talked about this 2 weeks ago. We have a huge step function in demand and inflation. We had consumer price index out yesterday, which I think had a pretty big impact on the market. We had a huge drawdown yesterday. And year-over-year inflation, I believe it was upwards of 4% for all total items. And what was really interesting on a month-over-month basis, the ex-food and energy component of inflation, which is usually lower, was actually higher. And it was due to what we talked about 2 weeks ago. The Manheim Index, used car prices were up 10%.
Yeah.
So time to listen to the Fed. I think the world is really starting to look at the 10-year as having a pretty substantial upward bias. And positioning in the market is really starting to move, thinking that long-term dated assets are going to have to deal with the 10-year. The Fed is going to let inflation run, which likely is going to take inflation higher, rates higher, and there will be an adjustment necessary to kind of deal with that.
So let me set the stage a little bit. So
Right.
the Fed has one of the most aggressive policies out there in our nation's history, right, to stimulate the economy. And so naysayers or critics of what the Fed is doing are saying, look, we've fully recovered. I mean, or very close to it. Some saying we're in new highs. It took 6 months for retail sales to reach pre-pandemic era numbers, whereas in the housing crisis in 2008, it took 6 years. Okay, so 6 months. So we had a swift V-shaped recovery that a lot of people were thinking wasn't possible. And so a lot of naysayers are saying, look, what you're doing is going to cause even more and more inflation. It doesn't really resonate with the economics. And you're buying $120 billion of asset purchases every month, $120 billion of cash going into the economy, right? Keeping interest rates at all-time lows, which is potentially starting to create some bubbles, right? And is going to create lots of inflation that is going to be down the road. And so what you're saying is, well, the Fed is saying, yeah, we were expecting to have some of this inflation. You've talked about it before on this podcast of the pig and the python kind of phenomenon, where we have this built up demand, we have shortages of supply due to the global supply chain getting disrupted during COVID. And so, you're going to see this surge in prices, but transitory meaning they're going to fall back down, and that we still have more fighting to do as far as the Fed is concerned. We're saying maybe we should listen to that. And I think when we were talking about this as a segment, it was because we got a new jobs number, right? I mean, that was kind of the first evidence that the Fed might be onto something.
Yeah, it was our first economic miss.
Right.
So last Friday, we actually had a jobs number. It was a miss by upwards of greater than 50%. It really spooked individuals thinking, oh, wait a second, maybe we're not on the greatest footing after all. Fed knows what's going on. And, just recently, in the last week, I've heard two really intelligent individuals speak. And one of them really spoke to, why is it so appropriate for us to just discount Fed officials? These people are exceedingly intelligent. Why are we just going to discount what they're doing as ineffective? Ben Bernanke, when he was doing what he did after the Great Recession,
right,
effectively choreographed one of the greatest recoveries that we've seen, all through very new and novel monetary policy. So why would we consider that what we're doing now is just a bunch of buffoons who don't know what they're doing? I thought that was interesting.
Well, yeah, I think my counter to that would be, why would we consider anything else? Of course, I think if you look at any Fed chair, right, going back throughout history, you haven't had raving fans out there. Everyone's always criticizing them. So we should kind of expect that.
That's true.
Right?
That's
and kind
true.
of read those tea leaves a little bit.
So I take that idea that maybe they know what they're doing. Let's get behind it, and Feds can produce economic growth. And then I think about another name that really came out. It was actually this week on kind of early AM show. Stanley Druckenmiller was on, who runs a big family office in New York, and he's a big capital allocator. He does things a little differently than I might do investment wise, just because of the wealth that he actually manages. However, his viewpoint was a little more bearish than what I've seen from most perspectives. And so I'm trying to balance those two thoughts.
Yeah.
Right? I'm not just glass half full, rose-colored glasses. Everything's great. I'm trying to look.
Well, he's
from
bearish on interest rates, saying that they're going to go up dramatically.
He's bearish on that policy is created asset bubbles and there'll be things to pay. And it's probably somewhere in between. Right? We're probably somewhere between. We probably don't see inflation that takes off upwards of, say, 5, 6, a continued 4% every year for the next 10 years. That's probably not the case, and we're probably not have some horrific asset bubble. He's probably in the middle.
Right. He also said that a V-shaped recovery was impossible, which he at least conceded that he was wrong on that fact. So that's good. So we'll talk a little bit more about that on the couple topics from now, talking about inflation. But I wanted to talk a little bit about in this episode about Biden's tax proposal. So we talked about it last week and the week before, and something that I think is going to be a continuous eye for investors is this tax proposal has a lot of implications for capital gain assets. And so one of the things that I wanted to address was that in this Biden tax proposal, it is proposed to eliminate 1031 exchanges on any gains over $500,000.
So give me an example where I would use a 1031.
So a 1031 exchange is in real estate when you have a like for like. If you hold real estate for investment, okay, so this could be your first home that you held and rented out. You can own an apartment complex, a hotel, a family farm, right? If you own investment real estate, you can sell that real estate and you won't have a big built up gain, but you can exchange it for another piece of real estate and not have to recognize that gain and pay taxes on it. So you in essence defer your taxes until you end up selling that property. Now, what many investors, real estate investors, do is they're on this continuous loophole of 1031 exchange, and they're just gonna do it so long as they're alive. And that's the plan, is that I'm going to defer my taxes until I die. And they've had a benefit in doing so because we've had something called step up in basis, which have wiped away, essentially, when you die, if you have any deferred capital gain assets, stocks, mutual funds, bonds, real estate, what have you. If you have any assets that you have not yet recognized a gain, your family or your spouse can sell those assets. They get a step up in basis. There'll be no gain due. Okay, so that's what the rules ban. So a lot of people look to defer, which we always caution people about. I've been cautioning people about this for my career and, of course, on this podcast. Because now here's what we're looking at is eliminating the step up in basis on anything over $1 million per individual. So this is going to have major implications and consequences for small and mid-sized real estate investors, right, who've deferred capital gain assets, who've depreciated those assets, right? So another thing you could do in real estate is you can depreciate your cost basis, essentially recognizing a portion of what you paid for the asset every year to deduct against income on your tax return, right? Creating a larger and larger gain down the road that's going to have to be managed or recognized. And so this proposal, right, would have serious implications to real estate investors if it passes. By the way, 1031 exchange came into law in 1921. Wow. So exactly a 100-year-old law.
Later.
And here we are. And so, the other thing is there's a lot of people who won't be affected by it. You can still 1031 exchange a $500,000 gain, right? And so So it's not elimination of it total, but larger real estate investors, I think, the administration has been pretty targeted on who they want to pay the tax.
And so far, the language has been $1 million and up. As far as
that's on the step up in basis,
okay,
right? And so there's going to be major, and we're going to talk about this in future episodes, as we keep peeling back the onion on this tax policy, is there's going to be massive implications for estate tax planning that we haven't seen in over a decade. Okay. And that's something we're preparing our clients for, and there's going to likely have to be lots of work done in the coming decade as we see changes to step up provisions, estate tax exemptions, 1031 exchanges, ordinary income rates, capital gains rates. I mean, the tax code's changing, and not to our benefit, right?
Well, that makes a lot of sense. Lower rates, build up asset prices, grow the economy through higher asset prices, and then change your government policies to tax those asset prices as they change hands down the road. Right?
Which is something we've been talking about for 10 years, since the last recession. I mean, you can just see where the deficit is going. I think we brought up a deficit chart in our last show. So what do you think we're going to do?
Yeah.
We got to pay the debt. Where's the source of income that's going to pay the debt? There's only one source of income for the government, and that is tax revenue. And so it's pretty simple. If you need more income to pay off your debts or to keep pace with interest, or just to not go into deficit spending and build the debt, you're going to need more income. Or we could, of course, cut the budget, but we're not doing that. We're doing the opposite. We have a $1.8 trillion stimulus, $1.8 billion infrastructure bill, right, that we're putting forward on top of all this debt. So, so something that we're going to watch closely over the coming months, and we'll bring you news on future shows and episodes on this tax proposal. All right, so you talked a little bit about the inflation numbers already. CPI year over year, the consumer price index 4.2%, right, after April. So 4.2%. Now, of course, it's going to be higher. April of last year, everyone was sitting in their home.
At home, right? And we're targeting an average of 2.
Right.
So when we think about 4, you think about that as a benchmark versus kind of 2, it would be acceptable.
Yeah. So, but the total increase in prices in the month of April alone was almost 1%, 0.9%.
It's a big number. Now,
I mean, that's sans food and energy, by the way.
Let's take this conversation and get out of the numbers for a second, and let's just talk kind of Dustin and Luke here about inflation.
So long as you give me permission to come back to the numbers.
You got it. Yeah, okay, you come, but just in this moment, because this is impacting me personally. So I look at this number up 4% year over year, and they say it's a lot of it, ex-food and energy, is because of car prices. And I can tell you right now, I need a new car. Now, there's no way I'm buying a car right now. There's no way I'm buying a car, a used car. The prices are too high. I throw up in my mouth every time I think about it. I'm not going to do it. And so there's an old saying that high prices cure high prices.
Right.
And in this case, I'm just using my personal anecdotal evidence. There are certain things that I'm choosing to random walk into. I'll go have dinner with my family, and I'll pay the expensive fee for that because that's enjoyable to me. But when I look at sticker prices of a car, if I just wait 6 months, I might be able to get it for X. If I want to buy it today, I can buy a used one for sticker price of a new car plus $10,000. And I throw up in my mouth when I think about it. I can't do it. I really come back to high prices do cure high prices. That's been proven decade after decade after decade after decade. So I'm a little more sanguine about what inflation will be. I do believe in this thesis that we're more of a step up, but I kind of want to hear your perspective on what's going on.
Yeah, I mean, so I guess, yeah, if you're buying a used car, right, you're paying more. However, you have a used car that just went up 10% last month.
Yeah,
when as a financial advisor, when have I ever put down an automobile on a balance sheet for a client and then assigned a 10% growth rate? Okay, so we haven't had inflation in a long time, and gosh, I've been ringing that bell pretty loud, and you've been helping me out, and I mean, we've been calling for it, right? We've been planning for it, we've been educating people about it, and this is what inflation looks like. Money in the future is worth less. Okay, so you are going to have to pay more for cars in the future. You're going to have to pay more for houses, for food, for gas, for school, for clothes, what have you. That's what inflation is. And so we see these numbers coming through, and yeah, things are starting to cost more. Now, right now, you have the benefit of buying that car with an extremely affordable interest rate. Okay. Now, what is concerning is when that changes, because I think it's going to change. So coming back to the numbers on CPI, we had this massive reading. Now, remember, the consumer price index, about a quarter of that, 24%, is rent. And rent is going down. Rent is flat and going down because of, obviously, COVID. And actually more so because of the housing, I won't call it a bubble, demand, increase in demand for housing, right? So people want to own, right? They don't want to rent. So if you want to keep them, and they have really affordable mortgage rates, so they can afford these larger mortgages versus paying you rent. So landlords can't really increase rents right now because interest rates are low.
That's right.
Right? Think about this.
Yeah.
Landlords can't increase rent, cause inflation, because interest rates are low. Now, what's happening, we've got this big reading on this number. Okay, so eventually what's going to happen is rates are going to have to start going up. Guess what happens to rent when rates go up? It increases, right? Because now those renters can't afford that larger, a 5% mortgage is a lot different than a 2.5 or 3, right? And now the ability to increase rents starts to happen. And so you start to have some kind of, tailwinds or headwinds on inflation and interest rates at the same time. So as interest rates go up, it could cause more inflation in areas of that CPI number. And so something that's going to be an interesting phenomenon, but it's just math. We can look at the math. We kind of know that phenomenon is going to occur down the road.
Yeah, I believe
it's something I'm sure the Fed is very aware of.
Well, and I believe the component in CPI, it's called owner's equivalent rent, right? So they don't actually look at what people are paying in their mortgage rates or house prices. That's not part of CPI. It's actually how much people are paying in rent. So that's an interesting component. I hadn't actually thought of that.
Yeah, and so real estate's rising. Here we are. People want to own, so it's creating that. We've talked about how real estate could potentially flatten off with an increase in interest rates as housing becomes less affordable, as mortgages become more expensive, meaning more people are going to have to rent, and that rent is going to start to increase, right? And so that's just something we have to prepare for in the future. But again, inflation is money in the future is worth less. The other thing that happened when we got these inflation numbers is the market went down, right? The market doesn't like inflation. And so I think a lot of times when you look back at all the stuff that's worked, right, over the last decade and certainly over the last year with COVID, some of these mega cap names in technology or large companies with no earnings, right, that trade on valuations that don't really have any data to come up with a price.
Well, maybe think about it this way. The earnings for those companies is maybe a decade in the future.
Right.
And so as your denominator moves up, your interest rates move up, you're actually discounting that value back. So I've been referring to it. It probably gets lost on a lot of people, but I refer to them as long duration assets. So long duration assets would be long treasuries or growth assets with growth moving into 10 years from now, 15, 20 years from now.
I mean, if you look at something that trades 15 times earnings, let's just say, hey, I'm looking at the next 15 years, right, versus something that trades 40. Well, if money in the future is going to be worth less, and that's the reading we get, you have to discount all of those years in the future at a much higher multiple to get to the price today.
Right.
And that's just math. And so as you start to have these rising interest rates and inflation, what does it do to these long-term assets, right? Those high growth names with very large multiples, as well as these long duration fixed income assets, right, where you're going to recognize income in the future. All of a sudden that money is going to be worth a lot less, and that goes into the reading like that.
So that brings us to the point of potentially you're going to move to timing the market.
Sure.
All right. So we can divide timing the market in two components, and one of them I would say market leadership. Right, so let's just think about timing the market in terms of I'm going to sell all of my growth stocks. I'm going to buy all my value stocks. We'll just take a victory lap here, and you and I made a great decision to make a trade and seeing momentum within our portfolios and making a trade ahead of it. It was very good. And actually, we had a distributor come in and say, "What are you guys doing?
Right?
What are you no one's doing this." And we just happened to see the momentum was something that we didn't want to participate in to the degree we were participating in. But I really want to point out, okay, let's time the market. Let's go all into value. So let's go buy all the financial stocks, right?
Yeah.
Let's go do that. And right now, what I'm thinking as I look 6 to 12 months in the future is wait a second. If we go back to run rate GDP, if we get all this stimulus and we get all of this excitement that gets cyclical stocks moving and GDP plus type stocks growing, what happens when all of that stimulus just is in the rearview mirror? People go right back to what's growing faster than GDP. And so when you start thinking about portfolio construction and timing the market in terms of where you're allocating your capital, you can just get lost chasing performance.
You can. And it also depends on what your time horizon is and what your view is, right? What are we trying to make decisions about for what time frame?
Right.
I mean, right now, I'd be looking at my portfolio and looking at the asset classes, sectors, and companies that I own and saying, how does people getting vaccinated help these companies, asset classes, or sectors?
Sure.
Right? Who benefits from people getting vaccinated? That's the story right now. It's pretty clear.
Right.
So look down the list and decide if this company truly benefits from people getting vaccinations. And that might tell you whether you are expected to underperform or outperform the overall market, right, in the short term,
so,
or for the rest of the year.
Right. And let me pull out the crystal ball real quick, and let's think about where we're going to be 12 months from now. Okay, so I'm thinking that companies that benefit the most from reopen, from vaccination, 1 year from now have difficult comps.
Right.
I mean, like, we'll have that conversation 12 months from now, and they're leading from now to then, they probably have higher valuations, higher excitement, a lot of chasing performance. Who knows? They might actually even become momentum stocks at that point.
Could be. I mean, and there's so much that we're juggling here with economic readings, multiples, so like Wall Street comps, interest rates, inflation, economic health, global economic health, right? Tax proposals. There's always a lot going on. Okay, now what unfortunately a lot of investors do faced with all this news is they get overwhelmed and they want to step out to the sidelines. So I think when most people think of timing the market, right, we talked about sell in May and go away philosophy, which just, in the beginning of the month started to seem like it might make sense. But
did you record this, by the way? No, you didn't record this.
But you know, investors going to the sidelines, essentially going to cash, right, or getting out of the market. And so when we think about timing the market, I'd like to drop the G. It's really time in the market. I guess that'd be Tim in the market.
Yeah, right.
Drop the G and add an E or something like that. All right. Sierra, I need you on the ones and twos, please. Okay. We're going to... So let's just look at the S&P 500 index over the last 15 years. Okay, over the last 15 years, wow, we've seen a lot. Right, 2005, gosh, the world was different. I don't believe there was any social media back in 2005. I mean, it was different.
I had a lot of more hair in 2005.
Yeah,
maybe
there was no smartphones. Yeah, there was no smartphones. There was no social media. I mean, okay, whatever. We were coming out of a recession, and then in 2008, Lehman Brothers went bankrupt. We had a housing collapse. I mean, and it was, I feel the pit in my stomach to this day, remembering those days, and how difficult it was, right? You had 2011, the market sells off because S&P 500 downgrades the U.S. debt, right? You had in June of 16, we had Brexit, right? The market panics. Earlier that year, you can see the little dip. That was the inflation reading that we got, right, where the S&P went down almost 10% because we had a higher inflation multiple. So we've talked about that before. You know, here we are in the end of 18. We had the trade war and tariffs going on. The market plunged almost 20%, 19.8. I guess there's no call out for coronavirus there, but that was a pretty significant event. So anyway, we've had a lot of events over this 15 years, and here we are sitting at the end of 2020 on this chart. And so what would happen if over this entire 15-year time horizon, you missed some of the best days in the market? So if we look at the results, and this is a study from Putnam, and all the big mutual fund companies have it, they put out that if you were fully invested over that time from December 31st of 2005 to December 31st, 2020 in the S&P 500, that index replicated a 9.88% annualized total return, almost 10%, right? And we talk about the importance of having a 15-year time horizon with equities pretty consistently. So here's the evidence of, and let's just admit that wasn't a great time to start investing, right? This was right before one of the largest downturns we've ever had in market history and a very slow recovery, right? But with time in the market, You got almost a 10% annualized rate of return. Your $10,000 would have turned into over $41,000. Now, if in that entire 15-year period, you missed just 10 of the best days in the market, your return was more than cut in half. Went from 9.88 to 4.31, and instead of having 41,000, you got only 18. That's just 10 days. That's just the 10, missed the best 20, the best 30, the best 40, and it's pretty dire. You missed the best 30 days in your market over this time where the S&P averages a 10% rate of return, you lost money.
I mean, you and I build financial plans all day long and know how compounding works. Like when you change your rate of return from 5 to 10 over 15 years, we're talking about a different life.
This is a different life. Add a 0 to these numbers or 2 and kind of put that in context of your stuff. Fidelity's study goes back to 1980. Right? They said, here's 40 years, a 40-year investing life cycle. Over a 40-year time span, if you miss just 10 of the best days in the market over 40 years, your return was cut in more than half. More than half, 10 days over 40 years. So look, how do we time the market? It's time in the market. It's pretty clear when we look at this evidence, it's pretty important to capture the best 10 days, whether it's 15 years, 20 years, 30 years, 40 years. So how are we going to do that? We better be in.
So this brings up something that I think really touches me personally and how I think about building portfolios and how I like to allocate portfolios across strategies and to individuals specifically. I think that each individual has a plan that explains their cash flows and needs, and there's a portfolio that has a level of volatility that meets their ability to withstand it.
Yeah.
And it's our job as financial planners and wealth managers to build that portfolio specifically for them.
Yeah.
So that they never think about the market's down. Like I know what I need for the next 3 years, 5 years, 7, 15.
And how do you withstand that? Exactly what you're saying. How do you withstand it? Withstanding happens with understanding, and understanding that I don't need this capital for 15 years from now. How should I react to a move in an inflation reading in April? It is not something that should come across your desk or even your thought process, and something that you would need to do as far as being in or out of the market for your 15-year time horizon.
That's right.
Right?
That's right.
So, all right, good show. We covered a lot here today.
There's a lot going on.
Yeah.
The market is interesting. Things are evolving, and there's a lot to talk about. Even hard to cover it all in 30 minutes every 2 weeks.
Yeah,
honestly.
Yeah, absolutely. Well, we'll always bring back more. In 2 weeks, we'll bring you episode 10 of season 2. And then for all your listeners, we really appreciate you tuning in and all of your positive comments, as well as some of your feedback of how we can make our show better. I know that there's a call for more information and education on cryptocurrency and blockchain. Luke and I and our team here at Presidio are planning to bring you special events that we're going to host over the summer to bring you some of that information. So make sure you don't miss out. Follow us on Facebook and LinkedIn, as well as subscribe to our YouTube channel. Make sure that you don't miss out on special events that are coming up this summer. We're going to talk about some of those topics that are near and dear to your heart, or at least top of your mind. All right, everybody. Wish you a wonderful rest of your week and weekend. Luke and I will be back here in 2 weeks with more of our perspective.
All right. Thanks a lot. Thanks for stopping by.
All right. Thanks, guys.